Hello YouTube, thank you so much for checking out this video. If you are new to my channel, my name is Mark, Mr. Dividend Investor. In this video, we are going to take a look at 3 companies that have been beaten down. These dividend companies, in my opinion, are solid companies that if it's not yet in your portfolio, you might want to take a look at it, as these are great companies that are on a discount right now. They're undervalued and they have proven track records of providing dividends to their investors. So hope you like this video. Sit back, enjoy. Do me a favor, hit that like button, hit that subscribe button, and don't forget to hit the notification bell so you don't miss out on any of the videos that I put out. As always, please remember that all of this is not financial advice. This is just me sharing. Without any more delays, let's take a look at these companies. So the first one I'm going to talk about is Starbucks, ticker symbol SBUX. For those of you that are not familiar with Starbucks, this is a company that engages in production, marketing, and retailing of specialty coffees. I'm a big Starbucks fan. I love their drinks. I usually go over there, grab some of their cold coffees. So you got some of great coffees if you ever want to go check it out. Take a look at the Simply Safe dividend. Based on the key metrics, you can see payout ratio is about 62. Forward payout ratio 61, a dividend streak of 13 years without a reduction. Looking at the dividend growth, you can see the last 10 years 17%, last 5 years, which is 10, and then you got your latest of 7.5. Again, what I'd like to see is that upward trend. You can see from 2009 all the way to 2022, you can see an upward trend. 13 years without a reduction, 13 years of consecutive increases. For those of you wondering, when you get paid, you get paid quarterly in the months of February, May, August, and November. Annual payout would be $2.28 per share, which breaks down, as you can see from the chart, with about 57 cents per the quarter. Okay, looking at some of the data, you can see maybe undervalued. Forward payout ratio, you can see right here. And then you got your 52-week range. You can see it's near the 52-week low. You got your PE ratio of 19 versus the consumer discretionary of 13. Sorry. Looking at financials, you can see payout ratio right there, 61%. Earnings per share, $3.76. You can see the sales growth. You can see outstanding sales, total sales in billions, return on equity, return on investment capital, operating margin, and you got free cash flow. Moving along to tip ranks. Based on their analysis, they rated as a moderate buy. You got 9 buy, 18 holds, and 0 sells. Based on their 12-month forecast, they rated as 17% upside. Currently, at the time of this video, it was at 74. They rated as 88. You can see the average, with the high of 112 and then the low of 75. Now looking down, you can see some of the analysis they rated as there's a mixture of buy and holds, you can see right here, with some of them going as high as 49%. You got a 30% upside. Now let's take a look at Seeking Alpha. Based on Seeking Alpha's dividend estimates, you can see one of the things I like to see is the dividend estimates. You can see from there 2024 $2, 2025 $2.47, 26 and $2.66. The rating you can see right here, it's a mixture of buy and hold. Now moving along to Simply Wall Street. Based on their share price and fair value, using their estimates, what they call the discount cash flow model, they rated as a 31% undervalued. Based on their fair value, the stock should be about 109. Currently it's about 74, as you can see from there. Moving along to Alpha Spread, you can see based on their estimates, you can see here as well, with the high of 126, the average of 91, and then you got a low of 75. And then based on there as well, you can see the flash free cash flow analysis right here, as well as some of the fundamentals: gross margin, operating margin. You get your earnings waterfall, you got your balance sheet. You can see 29 billion assets versus the 37 liabilities. Okay, now moving along to my next one, which is Nike. The ticker symbol is NKE. This is a company that engages in the sale, development, marketing of athletic footwear. Again, I am a big fan of Nike. I love Nike products. Purchase a lot of especially Jordans. I love Jordans, and great products in my opinion. Now let's take a look at Simply Safe Dividend. Based on their key metrics, payout ratio is 36, forward payout ratio is 47, dividend growth streak of 40 years without a reduction. As you can see, the recession they've increased during the 07 or 09. Looking at the dividend growth, last 20 years about 15%, last 5 years 11, and you got your latest of 8%. And then right here, dividend streak of 40 years without a reduction. Man, that is impressive. 22 years of consecutive increases. Now looking at the payment details, you can see quarterly in the months of January, April, July, and October. You got your annual payout of $1.48 per share, which breaks down to about 37 cents. Based on Simply Safe Dividend, they rate it as undervalued. As you can see right here, 52-week range. You can see it's close to the 52-week low, and P/E ratio is about 23 versus 13. Financials, you can see right here, payout ratios, earnings per share, free cash flow, sales growth, outstanding sales, total sales in billions, return on equity, return on investment capital, operating margin, and then you got your net to debt to EBITDA, interest coverage. Now moving along to tip ranks. Based on their analysis, they rated as a moderate buy, 13 buys, 17 holds, and 2 sells. And then you got a 25% upside, with the high going as high as 120, and then you got your average of 92, and then 67 is your low. Currently at the time of this video, it's about 73. Looking down at some of the analysis, you can see some buys, some holds, not that much sells. So again, definitely if you haven't had this opportunity, check it out. Now moving along to seeking alpha. Based on their dividend estimates, you can see right here again an increase in dividends per year. Ratings, you can see a hold and a buy based on the graph over here. Now quickly moving to Simply Wall Street. Based on their share price and fair value, they rate it as a 2% overvalued. Fair value would be $71, and then the time of this video is about 73. Now if we go to Alpha Spread, you got your fundamentals. Looking at some of that ROE, ROA, free cash flow, as you can see, fundamental scores, and then you got your price targets right here with the high of 126, the average of 95, and then the low of 60. Okay, next on the last on the list is Bristol Myers. The ticker symbol is BYM. This is a company that engages in development of biopharmaceutical products. Again, one of the companies that, in my opinion, if you want to take a look at it, you definitely check it out. Key metrics, payout ratio, again, it's 223, which is very high. Payout ratio, forward payout ratio is 35. You got your dividend streak right here of 53 years without a reduction. During the recession, they've maintained their dividend. Dividend growth, last 20 years, pretty slow, about 4%. Last 5 years, they've averaged about 7%, and then you got your 5% average. What I like about this is it's a steady increase as the years go. You can see 17 years of consecutive increases, 53 years without a reduction. For those of you wondering, payment details, you get paid quarterly in the months of February, May, August, and November. Annual payout would be $2.40 per share, which brings out to about 60. Looking at it, it might be undervalued. And then you got your price range right here. Again, $40 at the time of this video, which equal close to the 39-week low. You got your PE ratio of 6 versus the healthcare of 16. And then you got your other stuff right here. Free cash flow, sales growth, total sales in billion, return on equity, free cash flow, operating man, and then interest coverage. Now moving along to tip ranks, based on their analysis, they rated as a hold. You got your 27% upside with 51% at the time, $50, $51 at the time of this video is about 40. Then you got your high of 75, 51 is your price target, and then you got your 37, which is your low. Now going to simply Wall Street, based on their share price and fair value, they rated it as 69% undervalued, with the fair value estimate or discount estimate flow model of 132. Currently at the time of this video is 40. And then finally, let's look at alpha spread. You can see based on their intrinsic value, it's undervalued, 43% undervalued. And then you got all your other stuff in here. Financials, revenue, 10 years, 178%. Operating income, 10 years, 219%. And then you got your balance sheet of assets of 99 billion versus liabilities of 82. All right, those are in my opinion 3 solid companies that if none of those are in your portfolio, you might definitely check it out. These are companies that I definitely buying. I bought a couple of Starbucks, I bought a couple of Nike. I'm going to definitely buy some of Bristol Myers in the next couple of weeks. All right, thank you so much for watching. Hope you like this video. There's other videos as well, so definitely check those out if you're looking for other dividend companies to invest on. All right guys, stay cool, keep investing, and I'll catch you guys in the next video. All right, take care. Aloha.